Good afternoon. Welcome to the second live virtual Cube Workspace series. So it started out over a year ago with COVID-19, and COVID-19 has turned the world upside down. And in addition to all the normal difficulties that has made in doing business, one of the things that also causes to a certain degree is isolation and lack of touch with each other, which is great. So it is so great to see that we've got these live virtual events that Cubed is putting on. So we started last month with Cubed with the first presentation talking about tips and tricks for startups, and right now for this month's event, quite excitingly, we've got the Chief Economist of the Old Mutual Investment Group, Johann Els, here to talk about the markets and give us an economic update. My name is James. I'm from Villic Wealth, based out of Cube Workspace Morningside, and we all love a great comeback story. And even though there's so much negativity in the news, I am so excited to hear from Johann on his presentation around South Africa, the economic circumstances that we find ourselves in, and the fact that we've got a place to understand this, to ask questions, and to engage with someone, in my opinion, who is really on top of it and has real insights into the South African economy. So, is 2021 the start of South Africa's comeback? Johann Els, please take it away.
Hi, good afternoon. Thanks very much for the intro, James. Thanks very much for the opportunity. Yes, it's titled, Is 2021 the start of SA's comeback? I'm still struggling to convince many people because the title of the presentation, even though there's a question mark, actually says to you that I do think 2021 is the start of SA's comeback. And yes, as James said, there's still lots of risks around globally and in South Africa. There's lots of potential negative news still coming through, but I think that not only the COVID crisis, but also policy measures that has been in place for the last few years in South Africa will help getting us to a better medium-term growth path going forward. So as James said, you're welcome to type your questions, and my colleagues will stop me if there's anything interesting coming through. But of course, I don't want you to just believe me. Ask me and let's chat about my assumptions here. So SA's comeback on the back of a very strong global economic growth rebound. I think growth in South Africa will be very strong this year. I expect 5% growth. And of course, it comes off last year's negative numbers, but still very strong growth. And with that, strong rand, low inflation, low interest rates, and substantial reduction in fiscal risks. So all of that could help in boosting confidence amongst yourselves as businesses, yourselves as consumers as well, and investors. So potentially all of this can combine quite nicely to also then help boost medium-term economic growth, which in turn will further reduce those fiscal risks. So in essence, South Africa will be impacted significantly, not only by local events, but the strong global rebound that we're seeing, and that reduction in fiscal risk will significantly help build confidence and markets. Think of your investments, your pension funds, etc. So strong global growth rebound, and yes, big part of the strong growth that you can see in terms of my forecasts there for this year is just a rebound from last year, the bungee cord effect, what falls goes up. But also a big part of it, policy support, very low interest rates, quantitative easing in many of the large economies, and the fiscal support, especially in the US, where there's been significant fiscal support. As recently as December, a $900 billion package, a $1.9 trillion package in March, so significant policy support. So you can see the growth numbers coming through there, China as well. This will aid commodity prices very strongly. And look at some of the growth indicators here. These are the PMIs, Purchasing Managers Indices, and these are surveys amongst companies within manufacturing sectors, within services sectors, asking them a whole load of questions around what's your order situation like, what is actual manufacturing production, what is happening in terms of new orders, in terms of employment, etc. A whole bunch of questions compiled into one index. 50 is neutral, so above 50 is expansion. And you can see in all three large areas how manufacturing conditions have improved significantly, the middle graph, especially recently in the euro area where it's been lagging quite a bit. Chinese numbers have been falling back a bit, but largely impacted by the Chinese New Year celebrations in January and February, and that's also why the Chinese numbers have been weaker, because people haven't been able to travel. So services PMI in China are weaker, but all turning up. And if you look at the left-hand graph, the combined total of manufacturing and services, very strong rebound coming. Expect Chinese numbers to rebound in the next few months. So strong economic growth. But very importantly, in terms of policy, in the US, the Fed, the Federal Reserve Board, and the Biden administration still worried about the employment situation. Look at the dark green line, total non-farm employment. And especially this length of period here to compare the global financial crisis with the COVID crisis. So employment fell significantly during the COVID crisis, far more than what it fell during the global financial crisis in 2008-9. But also it seems the recovery now is far sharper and quicker than during the global financial crisis, where it took a number of years for the level of employment to get back to the pre-global financial crisis levels. This time around it's quicker, but the latest number is still 8.4 million workers below the peak in February last year, just before the crisis hit the US. So that level, that's still 8.4 million below, is what is behind all the policy support. The Fed wants the recovery in the employment to continue quicker rather than slower. The Biden administration wants that, and therefore the policy from the fiscal side, budget side. But importantly here, we're thinking about when interest rates in the US will have to go up. Now, the Fed's monetary policy statements, and the background is just a comparison between January and March, the last two meetings, just to show you that compared to our own central bank, this is a very short and concise statement every time. Very little changes from meeting to meeting. And the section that I highlight here in the middle has been unchanged since September last year. The Fed telling us that even though inflation is going up over the next few months, they will keep interest rates unchanged because they want inflation above 2%. 2% is their target. So they want higher inflation, and they won't, in reaction to that high inflation, hike interest rates. They want the unemployment rate on this graph, sorry, I'm confusing myself. The light green line, they want it lower than the previous lows early last year, without hiking interest rates. So they want high inflation, they want a stronger labor market without hiking interest rates. And that's important, but it's also confusing markets. Markets are not yet believing the Fed. The Fed says, and this is my own forecast for the US inflation numbers, the Fed prefers to look at this, the PCE deflator. It's a personal consumption expenditure deflator. The headline and the core, which excludes food and energy. Yes, I and the Fed expect inflation to rise above their 2% target, as you can see on this graph. But it's not a sustained increase towards 3, towards 4, towards 5%. That would be an inflationary cycle. This is just a reflection of from lockdowns last year to normalization this year, and then inflation will ease off again. But still, the Fed has got to convince markets that they're not going to hike rates despite higher inflation coming. In fact, the Fed vice chairman has said he wants the core PCE deflator, that light green line, above 2% for at least 12 consecutive months before he will vote for increasing interest rates. So that's significant, but still, that ongoing messaging in markets is important. And look at this.
Johann, can I jump in quickly?
Yes, please.
So the one thing that you said is that the recovery in terms of the employment numbers in the United States has been quicker than what has happened in 2008, which was the Great Recession, right?
Yes.
And then from that, there's an undertaking essentially from the United States Federal Reserve, which is sort of been made more sort of strong by them not changing their sort of policy statement really to keep interest rates low, so that they can encourage inflation to be at their target of 2%, so that it can stimulate economic growth. So my question sort of, how does why, number one, is the recovery so strong in terms of unemployment, and how does that like impact economic growth? You know, so like why is it so much quicker, the rebound of employment, even though there still are quite a number of people that aren't employed, but as a percentage it's quite low of the whole hundreds of millions of people in America. And then how does that relate to all the stuff about the Federal Reserve and interest rates and so on?
Yes, very good question. It's just the nature of this crisis, the lockdowns that lock down the economy and manufacturing activity and retail activity, travel and tourism, etc., and then the reopening. So it's much shorter and sharper than the global financial crisis type of event, which was an event that impacted the financial sector. This event impacted on virtually everything at the same point in time. So the lockdown and then the easing of the lockdown. So it created a far shorter, sharper cycle on its own. But it's that exact point that because it's now seeming to be slowing, that continued impact of the COVID infection cycle, rollout of vaccines, etc., that is impacting it to be slower. And the Fed is worried, the Biden administration is worried that because it's now seeming to be slower, if you look at the graph, it is not as short and sharp, the momentum anymore, that they want to keep on pumping money into the economy, keeping rates low to make sure that it continues. And of course, it's the whole circular effect in terms of economic growth impact from stronger consumers that have got more money to spend, that spend that in the market. And the last number of retail sales, for instance, retail sales in the US now far above the previous peaks. Retail sales have risen significantly. The last month alone was 10% on a month-on-month basis because consumer got these stimulus checks from government, spending it in the retail sector, need more people employed. So the circular effect, they are now rolling into the economic growth forecast. And that's why most analysts expect between 6 and 7% growth in the US this year.
Okay, thank you.
So essentially it comes, sorry, finger trouble. The light green line on this inflation graph is after the global financial crisis, essentially inflation has been below 2%. The Fed says it wants it above 2% for a similar period of time. And the fact that my forecast drifts off in the second half of this year into next year, again below 2%, that's the worry of the Fed. That's why they're not going to raise interest rates, because essentially this is a short cycle of higher inflation. It doesn't stay above 2. And so the Fed says, and this graph is what we call the so-called dot plot. Each participant at the FOMC Federal Open Market Committee meeting, that's the Fed's policy meeting, presents a forecast where they think interest rates will be at the end of 2021, the end of 2022, and the end of 2023. So this graph compares what the December impact was for those forecasts and March. And yes, there's a couple of extra dots above the current rate of the Fed's policy rate in the March meeting, but the median, the middle forecast is still for unchanged rates throughout the end of 2023. That's a long period of time. That's significant that a central bank should tell markets we're going to keep interest rates unchanged throughout the end of 2023. That's huge. That is significant. But of course, as I said, they need to keep on making this message and presenting this message to markets, because as inflation starts rising, markets don't believe the Fed. The Fed wants markets to believe them. Otherwise, market interest rates, bond rates, etc., are going up as well, and they don't want that. Because in the US, for instance, the household mortgage interest rate is linked to the long-term bond yields, government bond yields. They don't want that to go up too much, because then the mortgage interest rate go up, the construction market, the housing market gets under pressure. But essentially, if we look at the impact from this to emerging markets, because that's where we want to end up, what's the outlook for South Africa? This graph shows the dollar per euro exchange rate versus the US policy interest rate. And you can see in this period after the global financial crisis, when interest rates were flat for a long period of time, virtually zero at 0.25%. The dollar was weak. But the dollar started strengthening here around 2014, 2015, when the market started realizing interest rates are going to go up. And interest rates went up from late 2015 onwards, and the dollar strengthened. Now the interest rates are low again, and the Fed is telling us they won't hike interest rates before 2023, 24 at the earliest. So I think the dollar will again move more decisively in this band, 120 to 140 per year. Weaker dollar, because what happens? Very low returns in the US. Investors start looking for more attractive returns, higher returns in emerging economies. Money flows from the US to emerging markets. That weakens the dollar and strengthens emerging market currencies. So this combination of strong growth, strong commodity prices, weaker dollar, all good for emerging economies, good for the rand, good for South Africa. So a very supportive global environment, which then brings us to South Africa's own rebound. Firstly, on the short-term basis. So we had a significant slump in economic growth last year, -7%. To forecast +5%, thus, in my mind, isn't out of line. You can easily see a rebound like that. So the first effect is just the, as I said earlier, rebound, the bungee cord effect. Secondly, the global growth support. South Africa is a very small and a very open economy. 40% of our GDP is made up of imports and exports. So it's very important what happens in the rest of the world that impacts on us. So favorable terms of trade, that helps. Consumers will recover quite strongly this year. Now, people sit up and say, how is that possible? Lots of people are still unemployed. And yes, that's true. But looking at the actual data for last year, the slump, the collapse in spending was far more than the collapse in income. And if savings is just the difference between income and expenditure fell more than incomes on aggregate for the average consumer, then there's excess savings. And that makes intuitive sense because we were locked down, we didn't go out to restaurants, we didn't travel as much as we used to. Lots of the durable spend were not happening. Think of car sales that collapsed to virtually zero in April and May last year. So they spent up savings. So as consumers start feeling better about the economic recovery, as confidence move up, they will spend. There's also an inventory cycle that will help quite significantly, as lots of what actually spent last year happened out of inventories. So storerooms emptied out, shelves emptied, mining stock dumps emptied. So that meant that you don't produce for spending. And as inventories collapse, negative impact on economic growth. So last year's economic growth of -7 would have been -4 if inventories were unchanged between 2019 and 2020. That's significant. So as inventories, or at least the drawdown in inventories is slower in the first half of this year, and maybe in the second half we start rebuilding the storerooms, filling them up again, so inventories being rebuilt, that adds to GDP growth. Agriculture will show a strong rebound this year. We've had significantly better rainfall over large parts of the country with much better crops then coming through. Our biggest crop is the maize crop. That will likely be the second biggest crop ever in South Africa, larger than last year. That helps agriculture. And I think that another COVID infection cycle is likely later this year, but we came through the second wave of infections in January, February, fairly unscathed in terms of economic impact, without the hard lockdown of April, May last year. We only adjusted curfews and locked down the alcoholic beverage industry, and we came through that fairly quickly. So I'm thinking that if there's a third or maybe even a fourth wave of infections, then we won't have hard lockdowns like last year. A couple of points on that. I was talking about the impact on commodity prices. Look at this. This is the four biggest commodities that we export from South Africa: gold, platinum, coal, and iron ore. In the weighted price index, you can see how significant that increase was. This is last year, the slump at the start of the COVID crisis, the rebound, and commodity prices rebounded significantly more than that. That has got more impact than just on trade. It's impact on production, impact on employment in the mining sector, but also impact on mining taxes being paid. That has helped significantly in terms of extra revenue for government. So the total combination, if you look at import and export prices, this graph essentially shows that export prices are much higher than import prices. We call it the terms of trade. So relative between export and import prices. This is hugely positive for exporters in South Africa. But of course, all of that flows through in other areas of the economy. This is the inventory cycle I talked about, the light green line on the left-hand graph. Significant drawdown in inventories, negative numbers on the left-hand axis. As we slow that inventory drawdown this year and eventually building it back up in the second half of this year, that'll add to GDP growth. Look at that. Yes.
So if I can interrupt, I think this is a good time for one of the questions we've just had around the fiscal cliff that market commentators talk about and our current GDP crisis, and what measures government can and should take to recover that. Myself would like to know a little bit more about what a fiscal cliff means for South Africa, and if that's really just media hype, and what can be done, given also that I suppose government have in the past made a lot of promises and always overpromised and unfortunately undelivered. What does that mean for GDP going forward, given that you're fairly optimistic about the next year or 2 years?
Absolutely fantastic question. And I'll have more on the fiscal issues later on, but better growth, of course, reduces that risk around the fiscal cliff. Because if we talk about fiscal cliff, the one measure that we look at is government debt as share of GDP, a share of the size of the economy. And if we grow the size of the economy all the time, that ratio is easier to maintain or stabilize or get lower. So absolutely fantastic. The higher economic growth this year, the uplift in medium-term economic growth will reduce those risks. And I'll come back further to that point in a second. Just the infection cycle, we got through the second wave fairly quickly. There's still no sign of a third wave of infections. And I'm happy for you guys to share the presentation to everybody looking. So coming back to your question of fiscal cliff. Now, I've been doing this a long time. And I'm going to give away my age here when I say that this was my 45th budget. And it was one of the most positive budgets I've seen in a very long time. Apart from the ones that Trevor Manuel presented in 2004, 5, 6, 7, this was one of the best budgets in terms of being positive, fighting those fiscal cliff risks, and boosting confidence. So I think the risks have been reduced significantly by Treasury using the extra revenue that they got over the last few months by reducing the budget deficit, by stabilizing the debt ratio, that debt to GDP ratio, and by foregoing on those planned tax increases that they had penciled in for the next 3 years. And yes, there's risk around the wage bill reduction because they're focusing a lot of the expenditure reduction on reducing the size of the wage bill. But I think even there, there's some positive news coming up. And also, building on that confidence building, the planned lowering of the corporate tax rate from next year onwards. So there's a lot of positives within the budget. And this is the ratio that we talked about. The different scenarios that Treasury presented in the June supplementary budget last year, they said they can either go for the green line, which is the active scenario, reducing expenditure so that you can reduce the budget deficit, plus extra growth measures, lifting economic growth. The red line, they said, was too ghastly to contemplate, doing nothing, because then the debt ratio would just keep rising and we're heading for the fiscal cliff in that scenario. Now, fiscal cliff, before I talk about the other two lines here, of course, fiscal cliff is a debt default, meaning that we won't be able to repay our debt. Now, I think a lot of things can actually happen before we get to that. So a debt default in its own, I think the probability of that is far below 20%. Because before we get there, some other measures can happen. We can go to the IMF and we get a structural adjustment package, and the IMF will dictate economic policy. Or we can go prescribed assets, which I think is a very low probability as well. But there's a number of other things that can happen before we actually get to the debt default or the actual cliff. But I suppose that's a moot point on its own, because markets will react as if you're heading towards that debt default. So we don't want to get anywhere near it. And that's why it's so important that in October last year, Treasury presented this blue line as the debt to GDP ratio. Markets didn't like that. I said that's a horrific budget in October last year. But then in the February budget, they reduced it to this orange line. So a much lower peaking of that ratio and an earlier easing off. And that was far better, because I'm now thinking that if economic growth lifts, as I'm forecasting 5% this year and better medium-term outlook, we can actually reduce that orange line even further. So this budget, this economic environment, significantly reduces the fiscal risks, because it's all about growth. Our problem number one in South Africa is lack of economic growth. In the good years, economic growth, the green line lifted quite substantially. We managed to reduce the budget deficit, that orange line. And in your own personal finances, if you don't run a big overdraft every month, you're sort of running on balance position, you're able to reduce your debt, the dark green line here. But in the bad years, the Zuma years especially, if we call a spade, growth started collapsing, budget deficit exploded, and debt went up. So the bad years. We need to get back to better economic growth.
So you want to quickly jump in there? Okay, so
absolutely.
We look at that. One of the questions that came through spoke about commentators saying that historically Treasury has been optimistic with its numbers, with its projections. And I think in a chat that we had in the past, you showed some of those sort of what they projected the time before and what it actually was. But what I think is interesting looking forward, and we can all agree that there were some horrific years. There were finance ministers fired, when most of us were asleep, and there were serious issues that were happening. There are new sort of things afoot. I mean, I think we've got a really great finance minister now. So I just actually want to ask the question about the strength of the Treasury and the Minister of Finance, and just even our Reserve Bank as another one in terms of debt and that sort of thing.
Absolutely. Great question to ask here, because I actually need to address this. I think Treasury, well, let me start here. Lots of media speculation, lots of people saying Treasury is weak. They've lost a lot of good people. The minister isn't involved because he sits on his farm. I think that's all rubbish, or at least it's not the case anymore. I think Treasury is back. Treasury is as strong as ever. I know many of the top people in Treasury. They're very competent people. They're very clever people. I think they've got the backing of the minister. I think the minister, even if he's on his farm, is heavily involved, and his own signature was all over that budget, including that addition at the last minute stage of the corporate tax rate cut in the budget speech. It wasn't in the budget documents itself. It was just in the speech. I think Treasury is as strong as ever. Yes, it's correct that sometimes Treasury's assumptions was perhaps overly positive, but I think a large part of that was the downside surprise in economic growth every time over the last few years. And a big part of that, and I'll come back to that, was lack of confidence. But Treasury wasn't alone in their growth forecast assumptions over the last several years. They made some assumptions, shocks happened in the local economy, and growth came out lower than expected. I remember a graph, and I haven't got it anymore. I can update it, I suppose. With growth forecast being revised lower and lower and lower every year over the last 10 years because of negative policy, negative confidence. That has changed with President Ramaphosa, where things are starting to look better in terms of policy change. We all believe policy change is not enough. doesn't go far enough, it's implemented too slowly, but at least there's policy change now. In the Zuma years, there never were. In fact, I think Treasury's growth forecast this year is too low. It's below consensus. It needs to be revised up. I think we'll see the benefit of higher growth coming through later this year. So I think we're on the right path. The forecasts aren't overly optimistic this time around.
Okay, cool. And then I think just on that, the other sort of institution that's critically important, especially with regards to debt and the way that we have engaged with COVID, in particular the quantitative easing and that sort of thing that we've been doing as many other people in the world, is our central bank, our Reserve Bank governor. Can you just sort of give us a bit more insight into that and just our Reserve Bank governor, has won multiple awards for the role as a central bank governor. So I just want to, that's an important context. Is the Treasury aspect of the Minister of Finance, but another important player in this realm of discussion is also the Reserve Bank and the governor.
Yeah, absolutely. I think I myself was critical of the Reserve Bank last year not going for full-scale QE, not cutting rates more aggressively. But I think in the end, the way that the Reserve Bank managed economic policy last year just confirmed what the world knows, that they're a conservative institution, that they will not be dictated by the private sector, by the government. They've got their own mind. And through that process, continue to emphasize their independence from everybody. And I think now they're reaping the benefits of that, given that everybody still believes that the governor himself, his team around him, they're very conservative and very independent. And I need to make this point because people ask me, but what about nationalization of the bank? That has got nothing to do with the independence of policy making. So even if and when they have the money available to buy out private sector shareholders in the bank, that doesn't change the fact that the Reserve Bank's independence is enshrined in the Constitution and the Reserve Bank Act. And I don't think that is going to change under any government in South Africa. We've seen over the Zuma years, essentially, that the Constitutional Court is independent as well. We've got a strong judicial system that will protect those laws and Constitution. So I don't think the Reserve Bank's nationalization, that's a storm in a teacup, but it doesn't impact on the independence. So absolutely, your point being that our policymakers are as strong as ever in terms of Treasury and the central bank.
Thanks a lot, Johann. And may I just say, for everyone on the call, please, if you do have questions, please put them through on the Q&A, and we really try to get through them. Thank you. Carry on, Johann, please.
Okay, so we talked about the global economy rebounding strongly this year. We expect a strong rebound in the SA economy this year, from -7% last year to +5% this year. Of course, we can't expect it to continue at 5% into the medium term, but I do expect some improvement in the medium term. We need to compare that to the 5 years before the COVID crisis. So in the 5 years to 2019, annual average growth was just 0.8%. So less than 1%, as close to zero as anything. So we need to lift that medium-term growth. And I expect that to lift to around 2% on a medium term. So it's not great. It's not the 3.5% that would be better. It's not the 7% plus that we talked about 15 years ago. But 2% on a sustained basis is more than double the 0.8 we had to 2019. So it's an improvement. And that will significantly further reduce those fiscal risks. And a lot of things behind that, and I won't necessarily go through each point here, but a lot of policy change has happened. I think if we talk about medium-term growth from next year onwards, the COVID impact will be reduced from next year. Vaccine rollout is slow. Some experts say that more than 50% of the SA population are already infected. So we're closer to herd immunity in any case than what we think. Fiscal consolidation is happening, but it's happening slowly, so it's not too negative an impact on the economy. Eskom, and I strongly believe that the impact will be far reduced from next year onwards. So load shedding risk is lower from next year onwards. Eskom has done a lot in terms of their maintenance program. In fact, that was behind the load shedding a month ago. They didn't stop planned maintenance when there was this unplanned breakdowns. So maintenance program will gradually have some benefit. There's also extra capacity coming online. So reduced load shedding risk from next year onwards. That will help. Lots of other policy measures, infrastructure focus, modernizing infrastructure, lowering the cost of doing business, other market-friendly changes, etc., etc. I recently was on a call with Operation Vulindlela. That's a team within Treasury measuring the implementation of policy change. They've got a direct line to the president. If the department doesn't implement policy, they call up the president or his office at least, and he gets in contact with the different departments. So things are busy improving in terms of implementation. So this will gradually lift the medium-term growth. And we can turn around that downtrend in growth. So you can see over the last decade, 12 years, and then I talked about the last 5 years to 2019, that was just 0.8% on average. We can turn around that trend towards 2%. And that 2% on a more sustained basis is what's going to make a difference. In terms of the fiscal ratios, in terms of unemployment impact, etc. Gradually, that will lift confidence. And gradually, investors will start looking back towards the inherent positives in the SA economy. And we talked about the policymakers, Reserve Bank and Treasury already. I find that I haven't shown this slide in the last few years because when people are negative, they don't want to see the positives. But when things start changing, people will look, investors are starting to ask questions about these things again. Lots of inherent positives for the SA economy. James, I need to mention in terms of the independent central bank as well, that, you know, when Turkey's central bank governor hiked interest rates a few weeks ago, he was fired. That's not something that can happen in South Africa. It's impossible to happen in South Africa. So that is what investors start looking back at and say, hang on, it happens in Turkey, it happens in Russia or Brazil, it doesn't happen in South Africa.
Can you tell us why, Johann?
Why it won't happen in South Africa?
Yes.
Because of the Reserve Bank Act constitution that says the central bank is independent. So, and of course, the political leadership from President Ramaphosa. I cannot believe that he will fire the central bank. And that the private sector here in South Africa can go to the courts, go to the Constitutional Court and say, that's unfair, he can't be fired.
So it's one of the safeguards that have been built in.
It's one of the safeguards in terms of that independence of the central bank. But cast your eye through that list. I'm not going to mention every single one, but there's lots of inherent positives of the SA economy. And the point here is that as things start looking better, reduced fiscal risk, better economic growth, investors globally are going to compare us, looking at this list, to a Russia, to a Turkey, to a Brazil.
I mean, if I may jump in, Johann, I mean, one of the points there is huge mineral wealth. And I think that was sort of, it showed because our economy didn't do that well in the last year, but stock markets have soared and the JSE has done really well. And a lot of that was on the back of the commodity boom. And I think the quantitative easing, is that not correct? That is one of the positives.
Those are very true. And markets are looking ahead. Markets are starting to think this global growth rebound. We're starting to see the numbers playing out. The US retail sales that's jumping, the SA leading indicator. So markets are starting to believe that growth is going to be far better globally and in South Africa this year. I don't think markets are pricing in, though, yet 5% economic growth. The consensus forecast for growth in South Africa is still below 4%. So once markets start seeing an uptick in growth, starting to believe that, hang on, it might be 5% growth this year, it might be 2% in the medium term, then we're going to see the bottom line on this slide, this improved confidence amongst consumers, businesses, and investors. And then we'll start to see the impact coming through in the markets. So I'm using your question to get to this bottom line on this slide that I think 2021 could be a turning point for confidence as well. Okay, so let's look at that link between confidence and growth. And also, I haven't used this slide in a long time, but dusting it off again because I believe that things are going to start to improving for confidence as well. So this graph shows real GDP growth or economic growth versus confidence. And this measure of confidence that I'm using here is a question that the Bureau of Economic Research at Stellenbosch University asked businesses in their business confidence survey. And the question is the political climate a constraint in terms of you investing in your own business? And when the green line was this low, year around 2002, 3, 4, it meant that businesses say, no, there's no political constraint. We trust politicians to make the right economic policies to get high economic growth. So I'm very willing to invest in my own business. And this green shaded period was when Trevor Manuel was Minister of Finance, Thabo Mbeki was President, Tito Mboweni was Governor of the Reserve Bank. So a period of political stability when investors trusted the policymakers and economic growth was high. And then in the ensuing decade, the Zuma years, that worry, that concern about politics moved up dramatically and growth came down. Now, of course, it's an oversimplification because I ignore interest rate cycles, I ignore commodity price cycles, etc. But it's a nice illustration. Plus, then the Reserve Bank did a study in 2017 to measure this link between confidence and growth. And the answer was that had consumer and business and investor confidence been the same over the 5 years to 2017, as it was in those good years, then growth, GDP growth per year would have been 1% higher than the published number over that 5 years. So a full every year, a percentage point higher if confidence had been higher. So that's significant, but it also makes sense. If consumers, if businesses, investors are more confident about where economic growth is heading, they'll buy, they'll invest, they'll employ more people, etc. So my point about this graph is there's a clear link between confidence and growth. But I'm also saying that we not only need to improve confidence, in other words, get this worry about politics down to boost growth. I plugged in my growth forecast for this year and the medium term into this graph. And as investors and businesses see growth picking up, that confidence will start improving on its own. So there's an interlink between confidence and growth. As growth rebounds, confidence will improve. And as confidence improves, growth will be more sustainable in the future. So better medium-term growth.
So Johann, just a
yes.
quick one there. With regards to confidence, the published number is still negative. Sort of when you look at GDP, what would that have to be for us to see positive confidence numbers in relationship to that? Okay,
a very good point that the question is making. Lots of us, consumers, businesses, investors, after this long period, decade, 12 years of negative economic growth, lots of us have become disillusioned. The Zuma years, no positive change in economic policy. And yes, the Ramaphosa presidency has been around for some time now, but it takes some time to convince consumers and businesses that the change are for the better, that it will have an impact. And I think that as this graph attempts to show that as growth picks up this year, as we start believing that medium-term growth will be better than what it was up till 2019, we'll see a more decisive downward move in this green line, this worry about politics and policy. So it takes a while, and as we see growth picking up, I believe there will be some impact coming through from that. Okay, so we've talked about better global growth, rebound in the SA economy this year, reduced fiscal risk, better medium-term growth. All of that sounds great, but also a couple of other factors. Inflation is very much under control. Yes, there's some upside risk from growth, from higher oil prices, so petrol prices gone up, electricity prices rising by 15% this year, but there's lots of downside pressure. From food inflation, great agricultural crops that will reduce food inflation. Rental inflation came down again in the published number this morning. Education inflation was much lower than last year. Medical insurance was lower than last year. The rand has strengthened. I think some of those cost increases petrol and electricity, might actually turn out to be deflationary. As we spend more on petrol, we have less to spend elsewhere. So there's lower price increases in other goods. So, and there's very limited pass-through from a weaker rand from last year. So inflation is going to tick up in April and May. That's just the base effect from last year. But thereafter, it's roughly around the midpoint of the target range going forward. So I think the Reserve Bank can keep rates unchanged for a long period of time. Just one point on food inflation. And people argue with me and say, well, how is that possible? Grain or bread and cereals in the CPI is one of the biggest drivers of food inflation. And if we look at the grain prices on the futures markets for maize and wheat on the left, I compiled that into one weighted price index and calculate that on a year-on-year percentage change basis on the right-hand graph, and plotted that with the CPI bread and cereals component. We can see that that orange line, weighted grain prices, are falling now. It's in negative territory on a year-on-year basis. Of course, thanks to the great maize crop that's coming, so market prices, future prices are looking ahead. And that's going to have downside pressure on the green line and other food prices. So I think food inflation will drift sideways this year, not go up significantly. I think food inflation was 5.9% in March. I expect it to be 5% by the end of this year. Food is around 14% of the basket. Rental inflation, 17% of the basket. That's fallen significantly and it's almost 0%. I think it'll fall further this year. So lots of factors within the CPI basket that is very much under control, which means that the Reserve Bank don't need to hike interest rates until deep into next year. But another interesting point on this graph, which shows the prime rate, the repo rate, the rand and inflation. Look at the rand line, the purple line. Rand has weakened significantly since 2011 onwards. But inflation, the green line, moved sideways and then lower. And that was to a large extent the impact of the weak economy. Businesses found it very difficult to pass on cost increases when the economy was so weak. So business profits, company earnings were under pressure, but inflation got the benefit. So consumers got the benefit. Of course, that's more clear when you look at rand falling from 2011 to about 2016. Thereafter, essentially, rand has moved sideways again, and there we saw the collapse in inflation again. So inflation very much under control. Rates, policy interest rates, prime rate unchanged deep into next year, second half of next year. So in terms of an investment decision, cash is trash. You don't want to be invested in cash. In this period, we talked about the markets not pricing in better growth prospects yet. I think you want to be fully invested, whether that's government bonds maybe initially and later on equities. But let me continue to the rand, because that's an important point as well. Last year, when the rand collapsed significantly, I looked back at the example of the global financial crisis and I said, the currency will strengthen significantly, because that's what happens. And the currency has strengthened significantly. And compared to other emerging market currencies, the rand is looking a whole lot better. I think the rand can strengthen more. And to look back at the example, we use this graph on the left, which is the nominal rand per dollar, green line, versus the theoretical valuation of the currency, which is inflation differentials. We as economists call it the purchasing power parity, or PPP valuation. Now look back at this graph in the global financial crisis, highlighted by that pink block. And as I said earlier, at the start of the crisis, investors take their money from emerging markets back to the US. That's the so-called flight to quality. Dollar strengthens, emerging market currencies weaken. That's that weak point at the start of the pink block. But then as the crisis unfolds, things start to stabilize, but the Fed keeps policy very expansionary, keep on pumping QE, as they are doing now. Returns in the US are very low. Investors take their money from the US to higher returning emerging economies. Dollar weakens, rand strengthens. And at this point, I need to mention that currencies probably overshoot on the weak side and on the strong side. Same thing is happening here. The rand weakens substantially. It's come back. I think the rand can come back further because I talked a lot about investors not yet believing the Fed earlier on. So some volatility in currency and bond markets at the moment. But I think as that risk on trade comes back in earnest, the dollar weakens further because money flows out of the US to emerging markets, the rand can strengthen further. So in the short term, rand determined by global factors, strong growth, strong commodity prices, weaker dollar. In the medium term, of course, the focus will shift back towards SA's fundamentals, growth prospects and outlook for the fiscal issues. And I think hopefully by then, another year or two, those things will look better as well. So the rand probably more stable over the next 2 to 3 years than what we've become used to.
Johann, just quickly to jump in there. So great. In the short term, there's great. There are a number of factors that could argue for the rand to strengthen more. The other thing, the thing that I want to say, well, the rand is never really going to get back to something like 5 rand to the dollar or something in that line. And I mean, we started against the pound 1-to-1, and being an emerging market, we slowly got weaker and weaker, right?
Yes.
So we can't think that the rand's going to go back to something like 5 rand. We're going to, because we run an inflation differential with the major currency in the world, the US dollar, we're going to have a weak currency, for want of a better word. But it's never going to go back to, it's going to strengthen, there's real possibilities of that, but it's never going to go back to a 5 rand or 6 rand to the dollar in normal terms.
No, absolutely what you said. This angle of this blue line, it goes up forever because our inflation is higher than that of the US. In the very short term, it might strengthen significantly further. I don't think it's going to get back to the blue line. Last data point on the blue line suggests that the fair value is 11.20. So I don't think it's even going to go back quite to there, even though it overshoot as it did in 2010-11. The angle of the blue line suggests that 5 years from now, 10 years from now, the rand is going to be weaker than where it is now. Of course, it's volatile around that blue line, but the blue line, the fundamental underlying position, suggests that over time the rand will continue to weaken. And of course, that is where you make your decision in terms of investments, because you invest for the long term, for 5 years plus, in my mind, at least. So, yeah, in the short term, some opportunity might be created by a strong rand.
Okay, and then the second thing that you said is more stable, right? So the I don't know the exact ranking, but the rand is one of the most traded and most liquid sort of currency markets around. So you see that possibly being more stable going forward.
From my analysis, if we think strong commodity prices, strong global growth, weaker dollar, and that's still in the medium term as well. And then local factors, reduced fiscal risk, better economic growth outlook. Not great, but far better compared to our own history, recent history. That should present investors with a more stable environment, and therefore I think the currency can be more stable. So instead of this significant angle in that green line from, let's say, the end of that pink block to that weak point late December 2015, I think we won't see a weakening like that. We'll see a more sideways move over time. But still, 5 years from now, 10 years from now, the rand will be weaker than where it is now because it follows that fundamental blue line over time. This graph is one of my favorite graphs because there's lots of interesting stories here. For instance, our own debt default in 85, the Rubicon speech. Many of my listeners are probably too young to remember a guy called Groot Crocodile and the Rubicon speech and those things, but I'm happy to explore that later on. Let me say and end off and then open up for more questions, hopefully. I think happy days are here again. As investors look at better growth this year, better growth in the medium term, continued low inflation, and a strong rand. Even a 12 handle on the rand dollar isn't impossible. And people say, hang on, how can you say that? But we're already close to a 13 handle. The rand over the last few weeks were going close to 14.20. That's close to a 13 handle. So I think a 12 handle in the very short term for a very short term duration is not impossible. But as I said, you don't invest for that, but that might create an opportunity to invest for the long term. And low interest rates. I think all of this can give a significant boost to confidence in the medium term in South Africa. And of course, there are risks, and I'm taking account of those risks. There's a couple of positive risks as well. In the US, the consumer saving, in other words, the collapse in spending even far bigger than the collapse in incomes than in South Africa. So consumers start spending on the back of policy support. And on the South Africa side, potential confidence upside surprise is a positive risk. So there's not only negative risks, but some positive ones as well. So the bottom line is that I think there's potential big boost to confidence this year as these things unfold, things that markets aren't pricing in yet. And that can set us up for a couple of better years down the line, reducing the fiscal risk as we move up with more sustainable economic growth. Let me end there, and then hopefully we've got more discussion and questions.
Yeah.
Thank you very much.
Thank you very much, Johann. That's great. Look, I think the first question that I want to ask is that we're all business people running businesses, and we've got to deal with the real facts of life. Sure, the stock market went last year. We had some good growth there in investment portfolios, but the economy is still really recovering. So as business owners, I mean, I know, let's just talk any practical tips or advice for us as business owners as we face this potential happy days. Like, what should we be thinking through as we look at the market in front of us and the market in which we play?
Yes, not an easy question to answer, because there's still lots of uncertainty, and we're working with our own money, and we need to make sure that when we invest, when we buy, when we make these decisions, that we're relatively sure of where we're heading. So it's not an overnight thing. It's not something that will turn on a ticky. But as we see data unfolding, we see better growth data coming through. We see the markets are starting to believe this. I think we can take confidence that things are going to improve. A big part of what we haven't addressed here is politics. And I certainly believe in, because when I listen to the good political analysts in this country, that President Ramaphosa is far stronger within the ANC, and we've seen some of that playing out over the last few weeks, than what many people are thinking. That it's very clear that he will certainly get a second term within the ANC. And I think that we will then be able to accelerate policy reform. So I think business owners just need to watch out for all the unfolding news, maybe reduction in the risks and increase in the positive numbers coming through. Because I strongly believe that better growth over the medium term will have a significant impact on markets, on the economic environment, on unemployment even.
Okay, great. And then sort of following on to so what you're saying, you have to read between the lines in terms of what's happening with government and the moves that are made. And for example, we've seen a lot of arrests. We've seen a lot of talk around, the ANC and the NEC, and a lot of sort of challenges. So we sort of need to try and look and read in between the lines and make our own decision of how that is working. And you're saying the political analysts are saying that President Ramaphosa is much stronger than what we might think, sitting from the outside looking in on our news feeds.
Yes, absolutely. So unfortunately, there's lots of risks in politics, but things are playing out in terms of the fight around corruption. The NPA has been slow recently, but last year we had some positive announcements. The ex-president's corruption trial is due to start in May, but I see he's fired his lawyers. Maybe that's a delaying tactic. I don't know that the courts will allow him that delay. But of course, we need to see that rolling out. We need to see the Secretary General of the ANC being pushed out of the ANC, or at least if that's temporary. We need to see these court cases building, because that will help facilitate further confidence improvements, and that will help. So there's a lot that still needs to happen.
Okay, all right, great. I want to then sort of just answer the last question that we've got there online, and I'm going to take it, Johann, and I'm going to move on to you for one or two more comments around asset classes. So I'll sort of handle the more direct question. So the question was, where do we put extra money right now, like risky or safe? So from a financial planning point of view, you've got to look at your financial plan. The one I'm going to go to now with asset classes and where you see different asset classes in brief. But from a financial planning point of view, in COVID times, it's critical to go back to the financial plan that you have and look and see where your gaps are. In particular, emergency funds are very important, especially to keep you out of debt or to manage your finance properly. So emergency funds are critical, and it's about seeing where your gaps are in terms of your investment goals. Asset classes, very interestingly, now versus a couple of years ago, even a year and a half ago, talking about equities, but in simple terms, you've got cash, bonds, property, equities, and what I would say other. So, Johann, would you just sort of make a comment on each one of those and sort of what the potential is for them going forward? You've already said cash is trash, which I agree. And then just sort of touch on them, please.
So, yeah, James, absolutely. You disappeared a little bit there, but I think I got the gist of what you're saying. From my perspective, and I'm not an asset allocator, I'm an economist, but from my perspective, absolutely, you have to go to your financial planner. You have to take your own risk profile in account. And I believe strongly in diversification and long-term investing. Having said that, I think in this economic environment that I sketched, I think in the short term, you probably want to be overweight government bonds. Virtually no cash, overweight government bonds. And then gradually, as the news unfolds, the news flow come through, I suppose you need to be ahead of markets, and markets are ahead of the actual events, but gradually you want to be overweight equities, because much better economic growth over the medium term, you want to be overweight there. But if I can take a step back, I think that SA versus global, and of course you want global investments, but I think in a typical prudential type fund, in a 5-year investment horizon, you want to be overweight SA. Better economic growth, emerging market environment in total is much better. Within that, SA, much better than the rest of the emerging markets probably, given the policy changes, given the inherent strengths, etc. So I think on a 5-year horizon, you want to be overweight SA, not underweight SA. And I think that's important in my mind.
Yeah, no, thanks, Johann. I appreciate that. So, that sort of brings us to the end of our session. It's the end of the second live virtual Cube Workspace event. I've really enjoyed it. I found it very insightful. I hope you guys have as well. Thank you very much for everybody's time, for everyone who attended. Our time is valuable. Thank you for giving us some of your time. Your time is very valuable. Johann, thank you so much. It's always great to chat to you. I always learn so much. Thank you very much.
Absolute pleasure. Thank you very much.
Just for Cube Workspace from Villic Wealth side, it's really great that we could have the opportunity to facilitate today and to bring you on here and to have this chat. And in closing, guys, please don't forget there are more webinars coming from Cubed, and in particular, the next virtual live event from Cube Workspace is happening next month, and it's going to be all about the POPI Act, which is something very important because our deadline is coming at I think it's at the end of June. So very important. We're very forward to that. To the Cube Workspace team, thank you very much. Thank you, Johann. Thank you, everyone. Goodbye.
Thank you. Bye.